Welcome back to Fresh Economic Thinking. You're with Cameron Murray. Today, a special guest, Moses Sternstein. You'll have to correct me, Moses.
Both are good.
Um, Both are good. Terrific.
Yeah.
You're right.
I say Sternstein, but sometimes people say Sternstein, and I don't really correct them. It's okay.
Great. That's a very Aussie way of letting people call you anything. We're very big on nicknames here. Um,
Yeah.
Moses, you write Random Walk, which is a terrific substack, and I relate to it a lot because you really just take an independent view of what are people missing on this topic, whether it's housing, whether it's big macro trends, you name it. How did you become a substacker? Maybe you can introduce yourself to the viewers and say, how does one begin to write a substack on non-consensus economics and macro views?
Yeah. It's a long and winding tale. I won't give you the whole thing of it, but I suppose like my whole life, even I grew up in New Haven. I was surrounded by academics. Everybody basically just acquired degrees for a living. I always had an inclination, both of what I like to do and what I was good at, is to be curious and be good at learning and, pattern matching and learning across domains and being incisive where there was an opportunity to do so. I think as I progressed, in life, I went to Penn, was very much in the liberal arts school, the working kids. It was like, I don't really understand what does it mean to be studying marketing or business? I'm here for the liberal arts. And then I actually went to law school. I was a lawyer at a white shoe firm for about 7 years. And, um, I think as I got up close and personal, certainly in law school, up close and personal with the academy, it was sort of, the opposite of what I would build. If the reputation was that it would be this place where you could be a good learner and be curious and be rewarded for delivering kind of new and incisive ideas, that it was sort of the opposite of that, I think.
Mm.
Not to pile on the academy, but more closer to the feudal system, I think, than anything else. But anyway, at that same juncture, I started as a professional lawyer, um, and not a bad place to train I think as a smart generalist. Like there's definitely certainly where I was working, our clients were investment banks and hedge funds and other sort of generalist endeavors, and the work that we did was spun off of their work, and so I did like that aspect of it. For other reasons, it wasn't really for me. It was. But yeah, and then I left. I went to a venture-backed company in real estate insurance. I knew nothing about real estate insurance. This is years ago, but it was a good opportunity for me. It was very early. I was like, I will wear the general counsel hat, but mostly it was an opportunity to kind of begin to take on other responsibilities. Um, and I began to sort of cement for myself that I was sort of good at this cross-functional learning and getting up to speed quickly in 0 to 60 learning curves and just being curious and
Hmm.
getting dangerous around things. And um, I also at that point, I think, began to appreciate, I think, probably the investment community and capital markets more generally, as there's a quote, the last true liberal art, said about Charlie Munger originally, but like, I think there is this, I think capital markets do more than any other space begin effectively reward that kind of curiosity and contrarian truth seeking, whatever you want to call it, but insofar as there's real skin in the game there. And so,
Yeah.
um, I started to get more into that world, and then I joined a very different kind of startup, not a venture-backed startup. We were really almost like a Palantir for hedge funds. We would take alternative data and do all kinds of cool things for long, short, active discretionary. And while I was there, I just started writing with a lot of the data that we had access to. Some of it published reports, some stuff that we could see, and there was nothing particularly. It was really what I found interesting at whatever intervals I had time to write it and put it together. Um, and and it kind of took on a life of its own. And I really liked doing it. I was good at it, and I felt there was a sort of a need for, um, from an analytics standpoint. I think there's a gap between what like strategy and sell side does, which is sort of analytically rigorous, but not terribly contrarian and not always fun to read. And then you have like FinTwit, on the other side of things, which can
Hmm.
be really fun to read, but not necessarily analytically rigorous. And it's like, could I carve out a niche between those two spaces that was both sort of analytically rigorous, but also fun to read, very chart driven? Um, and then, yeah, I mean, I think by nature, right? I mean, what the alpha is almost by definition having some combination of, a different view of the same facts or a different set of facts. And
Hmm.
it requires a little serendipity and randomness and discovery. And my impression in life, but also even within capital markets is that people tend to be pretty siloed for good reason, right? I mean, it's like,
Yeah.
it's like the multi-armed bandit problem, right? You discover, then you exploit. You can't live in discovery all the time. You got to get good at what you know. And there's a lot
Yeah.
of, the signal noise ratio for random discovery tends to be pretty high. But so that's really the crux of it. And that's
No.
sort of the animating thesis behind it is just like, it's part of his love of the game, love to learn, and then pattern match when there's an opportunity to do so. I think these ideas evolve over time. Um, there's some data
Yeah.
that points in one direction, some that points in the other direction, some are, strong ideas weakly held and then they become more strongly held, and some ideas, actually turn out not to be such good ideas, and then you adapt.
Yeah. Fair enough.
Um,
So
yeah, and
can I
then yeah,
jump in
go ahead.
then? So
Sure.
summarize, you trained as a lawyer, a lot of exposure to academia. You ended up in startups and capital markets and realized that this kind of class of investors who are looking to put their money really want to understand the world better than academics even. It's the true um, truth finding activity. And as you began to write, you sort of built an audience. Now, you mentioned a thing called alpha. Can you explain to a non-finance audience, besides a Greek letter, what you mean by that?
Yeah, sure. Yeah. Alpha, so beta is basically market returns, right? It's consensus returns. That's what beta is. Alpha is, is differentiated from beta. It's whatever, can be positive or negative in theory. I mean, negative is bad, positive is good. But like if you want to have returns better than market returns, that's what alpha
That's
is.
what,
It's like just to
yeah.
have a different view of the world. Yeah.
So you want to
To be
find a
early, different,
story
and
that's,
right.
yeah, you want to find a story the market's ignoring, but is true, that the market will eventually also realize is true, and hence get your excess returns by being ahead of the herd. Is that kind of a way
Yeah,
to
something. I mean, I
describe it?
think yeah, I think that if I was professionally investing all the time, that would certainly be, the most direct application.
Yeah.
I do some of that. Been doing less of it recently for other reasons, but we could talk about. But yeah, I think it's also by disposition. I get most curious where I find some, the zeitgeist is over or under indexed to something in particular relative to what I think it ought to be. And that's a bit touch and feel. How do you discern the zeitgeist? And I read a lot, but yeah, and I think that's just what I find interesting is just where it's like the meme, what's the one thing that everybody where you think everybody's wrong, basically. It's not that I think consensus is always wrong because it's not. Consensus is often right. I just
Yeah.
think that where it's interesting is where I think it's somewhat wrong.
Well, I think both of us think it's wrong in housing, and you've, for quite a few years now, described the sort of housing shortage as this fake story um, that has really animated the political class, but that doesn't seem to have evidence. So, how did you, as a lawyer slash capital market startup person, come to the view that that's all bogus, a view which I've come to from a different angle as an economist? How did you notice or realize that the standard story was wrong in your view?
Yeah. Well, yeah, there is no housing shortage and I have different variations on that theme is one of the, it's also again like by disposition I like to antagonize, I don't mean in a hostile way, but like, I like to poke at things that I know will some ways will get a rise out of people. There's a saying, if you want to make a lot of money, you lie to people who want to get lied to. If you want to do okay, you tell the truth to people who want the truth. And if you want to get run out of town on a rail, you tell the truth to people who want to get lied to. So,
Ooh.
I fall somewhere in buckets two or three there. I will say from a content standpoint, like, I think it's sort of obvious, but the benefit of hindsight is really true. Like the best way to grow is to tell your audience exactly what they want to hear, throw red meat, be very clearly on a side, and then that side loves to cheer for you, and the other side loves to hate on you.
Hmm.
I, very much like to disappoint my audience as much as I can by,
Yeah.
um, trying almost like identifying kind of what they want me to say and then saying the opposite of it. But that aside, I mean, the truth is like I started out kind of a believer in the housing shortage theory because it sort of intuitively makes sense. The sort of YIMBY argument, which I think apply more generally, is just like, if you have supply side restrictions, then then you're going to have supply short of what demand would otherwise, what otherwise demand would expect. So it's just kind of, it's almost obvious, right? That, and it's certainly true with respect to other to supply side constraints more generally, which it's probably why
Yeah.
I call the YIMBY movement fair weather YIMBYs, because the only thing they happen to be YIMBY about is single family zoning in the suburbs kind of thing. It's very curious. But I have another whole other riff, that on healthcare YIMBYism, is like the actual silver bullet is to be pure healthcare YIMBY. But so yeah, I think I sort of originally was of the view that, sure, yeah, I think, like, if you have artificial constraints on supply, then you're gonna have some kind of a shortage. I think what began to change my mind, and it's, I don't know what came first. It's just obviously the data doesn't really support it, and as on a number of different dimensions, um,
Yeah.
and
What's
once
the main one that you would say was most convincing for you?
I
The
mean,
main data point.
so many. I mean, it's hard to say what the main. First of all, I mean, almost like start with the theory itself. Like, it's very
Yeah.
underspecified, right? It's like, okay, there's a housing shortage. We have an affordability crisis, so to speak. Well, what's the right number of you? Like, first of all, there's no homeless crisis. At least that's not a shelter-driven problem, right? It's like we have
Yeah.
homeless people, but they're not. It's not because of lack of shelter. So it's not like a shoe shortage or a car shortage or something where people are going without. Like, people clearly are not going without. On the
Mm.
affordability side, it's quite like, okay, well, what's the right price that they should be paying? Because if
Mm.
you look at the data, you know, people pay, it's fairly fixed. They pay about 30% of their disposable income on housing. That just seems to be, there's some variation. It goes up and down a little bit, but that seems to be, what people are willing to pay, which already tells you something about housing as a good, which is like, it's a multidimensional demand good, right? It's not just selecting purely for shelter, and the demand for housing
Hmm.
is heterogeneous across space and time. And so, once you begin to look at that, and it's just like, okay, what is the right amount? And there's no clear answer, right? Like, okay, great. So the National Association of Realtors says we have 10,000 housing too short. Great, because they want to sell houses. But let's say, I mean, there's a few. Again, first you look at demographics. Trammell Crow, is a major developer out of Texas. He used to say, he loves real estate because the stork is on our side, right? Like, you can be early in real estate, but it doesn't really matter, because eventually people growth comes in to fill the gap. So even if you have some vacancy now, eventually it'll go away. That's not true, right? And it hasn't been true. It's increasingly not true. You can
Hmm.
actually, I'm not fully persuaded, but I increasingly think that, part of what precipitated the GFC was, in fact, that it was that the working age population, rolled over then for the first time. And that's sort of what led to that housing. Well, it really began to roll over before then, and so with demand slowing, the Fed lowered rates and to increase demand, and then there was
Hmm.
building, and all of a sudden the Fed began to dial that back, and the bottom fell out when it turns out that actually, we weren't growing the number of households, and but we
Yeah.
were growing a lot of supply, and that created a bit of a surplus. Um, so demographics aren't on our side. The if anything, you look back to longer time series, like price per square foot has actually been going down. And even more recently, again, builder margins have been compressing to GFC levels, right? So like, if you had a shortage, you would expect margins to get really fat and wide, but they've been
Yeah.
compressing. Prices have been going down. Um, even the most generous indices show basically flat, and on real price inflation, I think houses are, even the Case-Shiller, which is pretty generous, are below, basically been flat to down since they peaked in 2021, which, again, not consistent with the shortage.
Hmm.
There is, the new build premium, so to speak, has disappeared, right? So like, generally under normal conditions, obviously new builds sell at a higher price than existing homes, which makes sense. But all of a sudden, the new build premium disappeared. Is it because people really, what they like, that lived the so-called used house smell? It's like, no, of course not. It's
Yeah.
just that existing homes stopped trading, right?
Yeah.
So, all the bid ask got too wide, and trades stopped clearing, but the indices don't really measure. They don't measure the trades that don't clear. I mean, again, I could go on. Like, there's so
So
many.
That
Yeah.
seems like a pretty broad range of evidence that you've sort of pulled together. If this story is true, well, this should be true. If it's this true, if the story is true, this other thing should be true, and prices shouldn't be falling for 5 years. Um, so I guess my question is, why does like Matt Iglesias, Ezra Klein, and a whole bunch of wonky people buy this story to such a strong degree? Why has it become the identity such that, the policy book of the year last year was called Abundance, which was basically 50% about this thing that we have just discussed probably doesn't exist, which is a shortage of homes. And yeah, of course, some wealthy areas in certain cities, obviously, they don't want poor people living next to them. That's been true for hundreds of years. And in fact, I love to point out that Ed Glaser, the Harvard professor who's sort of one of the idols of YIMBY, has also lobbied against new housing in his suburb many times, and his academic colleagues always have a go at him for it. Why does the want class take this story so seriously when you, as an outsider, a lawyer, have just come in, looked at the data, and gone, this story doesn't make sense? Do you have a any
Yeah.
explanation of that, you reckon?
Sure. I mean, I have some theories. I haven't been a lawyer for a long time, but I mean, the without trying to, well, there's a few different things to pull on there. Like in terms of why consensus emerged around it. Um, Again, I don't know. I'm not in people's heads, but I think like most things like that, it usually requires some alignment of interest from a number of different groups where they then find they have a shared something in common. I mean, first of all, again, there to some extent there is a grain of truth to it, insofar as I think there are some places, for example, cities, where the argument for a certain kind of YIMBYism is already dense places to be more dense is I think a better argument. Because it was sort of alluded to at the beginning, I think density certainly in the suburbs, and we can talk about that a little bit more and what some of the ridiculousness of the YIMBY theories. Like in the suburbs, density, lack of density is a feature, not a bug. But once in the cities, that's less true. And certainly, if you're like a young person in your 20 somethings and you don't have kids and a family, and you want to optimize for serendipity and random engagements, so you don't care as much about safety, and you want bars open, and you want lots of people around, then density is exactly what you want. So if you wanted to bulldoze Park Slope or the West Village and build high rises there, I think the argument is a better argument. But again, to be clear, part of why Park Slope and the West Village are so desirable is precisely because they're not very dense. Um, and you sort of see this argument all the time is like all the demand signals are saying what people really want is single family or low density homes. So the solution must be let's upzone all single family for big multifamily. It's like, are you kidding me? Like you just said what people want are single family homes, and you want to knock them all down. If that's nuts. But that's where I didn't remember who came up with this. Like, well, people don't want housing; they want a house. So they don't want, housing is this broad category that an economist can look at and say shelter units and say they're all the same, but of course they're not all the same. And they, and who wants what varies a good deal. But I think part of why it coalesced into, there is alignment of interest. First of all, I think builders generally, why wouldn't builders want that, right? Like the unit economics in multifamily are obviously the best, right? Because it's the most units, the highest density. They're either cheaper to build. It's more revenue per square foot. So they're happy to do it. Certainly national realtors are happy to do it. I think on the policy side of things, I think it comes from the sort of instinct to centralize. I think it again. I don't know what Matt Iglesias thinks in his heart of hearts, but I think it probably irks him a little bit when uh, local towns are setting rules when he'd much rather be able to set rules at a more central level, whether at the state level or the federal level. And I think that's partly the preference there is just this general instinct of like it's not so much. And that's why I call it fair weather YIMBYism, because I don't think it's YIMBYism per se. There's no other thing that he particularly wants to deregulate, or even on the subject of housing. It's like, okay, you want to deregulate, so let's do away with fair housing laws. Let's do away with OSHA. There's lots of other things that we could do to make to lower regulatory barrier, EPA, which again, in
Yeah,
fairness, like these things are not. It's not only density requirements and zoning requirements that they have in the crosshairs. It just seems like that's it a lot of the time. Um, and
yeah,
and I think then also you have in the sort of the academic universe, as the economists and the sort of across the aisle piece is that you have there is alignment between sort of let's call them libertarian or classically liberal economists whose default, which I think makes sense and one that I share, is like yeah sure like regulation is Another word for regulation is to throttle, right? If you regulate the flow of something, you're throttling it
Mm,
back. And if you're throttling back supply, you are almost certainly artificially inflating prices, relative to what demand would otherwise hold. So
yeah.
I think that's partly why because it appeals to so many different otherwise disparate constituencies. It's a rare issue where you will get the business community in the form of builders, an academic community, across both sides of the aisle, and policy wonks all agreeing on something. And I think that's partly why. And then, of course, like a lot of people who want to move into houses can't afford houses,
Yeah.
which is a real thing. And
Do you
go
think,
ahead.
can I interrupt?
Yeah, of
Sorry,
course.
do you think there's something to do with the downwards mobility of the sort of academic journalist class in the last generation that they go, oh, why can't I live in this fancy suburb? I've done 3 master's degrees and 5 internships and I've never actually earned money, but because I'm in the right social class, I should live in these fancy suburbs and they're too expensive for me. And therefore, I write lots of stuff on the internet. Therefore, I want the places where I deserve to live to be cheaper. I don't want to live with all the bogans. I don't know if you know the term bogan, but the redneck class in the wrong
Yeah,
suburb.
the
Do you
lumpen
think there's
proles.
an
Yeah.
element of that? Because
I mean, I think, look,
the more I
I
see, the
think
more I
it's,
get a sense of that. Unfortunately,
I think there's definitely some of it. I would put I would put a somewhat finer point on it, which is I think certainly what I like to say is, for years, really following the GFC, the chattering class, the coastal elite, whatever it is, they kind of thumbed their nose at the suburbs. They wanted to live in the cities, boo
yeah,
the suburbs. Everybody should move to the cities. That's great. And then obviously the pandemic, just it started to flip a little bit before then in certain cities like Seattle and even in New York or something. But the pandemic obviously really flipped it, and all of a sudden you have these people who had been thumbing their nose at the suburbs in DC and in New York and Boston. All now they want to move to the suburbs, and they were, I think they were quite frustrated that the welcome mat wasn't rolled out for them. I think that certainly amplified the message, for sure. And
do you,
look again. Go ahead.
Yeah, sorry. Do you think falling prices for long enough will take the wind out of this story? They'll be like, oh, well, they just call it a success and say we need more. Because in New Zealand,
Um,
there's a big YIMBY movement, and prices are where they were nominally, or in real terms, about 7 or 8 years ago, pre COVID prices, and they're going, yeah, that was YIMBY success. We need to do more. Whereas I'm like, yeah, that was just a cycle. It happened in every country. Look at Canada's prices. And I also noted detachment to look across the border at other places, right? And they'll go, see, this is why house prices are high in my city, where you can go to any city in the world. It's the same
yeah,
trend, right? And even when they do that, they go, oh, yeah, well, look at Tokyo, right? Look at Japan. That's a YIMBY success. And I'm like, well, hang on. Apartment prices in Tokyo are up 60% in inflation adjusted terms in the last 10 years. And in Sydney, NIMBY heartland, most unaffordable, they're down 10% in the last 10 years. Can't you just look at the data? Like, when will this game be over, do you think? And do you have a view about,
right.
looking
Or like,
abroad?
why is there no housing shortage in Detroit or in Italy or that or in
Yeah.
suburban Tokyo or suburban Japan, right, where they're giving the houses away. There's never a housing short. There's only a housing shortage where
Where
there's a recent perk up in demand, but everywhere else it's like, we ignore those things. Which also some part of it too is like, okay, who's supposed to foot the bill for this house? For this, if you overbuild, it's not their problem, and then it becomes the developer's problem, right? And again, you look at builder
yeah,
margins, and they have compressed, and there's a they're telling you, um, you know, they're telling you what demand signals are like, which is that they are soft and there's plenty of supply. It needs to get absorbed before you need to build new stuff.
yeah.
Um, I mean, I think it's already tapered a little bit. It's obviously comes back. It's certainly not the fever pitch that it was,
Hmm.
a couple of years back. I don't know that it ever, strictly speaking, I mean, goes away. I think again, part of the issue is like the real shortage. It's such that we have it is, what I call the nice places to live shortage. And, the issue, again, not to be overly, provincial and indexing to the United States, because as you say, actually, like lots of these trends, whether it's, the own to rent ratio, the effective interest rates, which is the real driver here, at least the most recently, like, those relationships. If you look at you compare places that have floating rate mortgages versus places that have fixed rate mortgages, and prices with floating rate mortgages, prices corrected as rates went up, as they did in like in the U.S. in the commercial real estate market. Where commercial real estate, which includes multifamily, it's not just office buildings, right? They don't have the 30-year fixed rate mortgage. Like that's the one simple fix to unglue the housing market would be to retroactively kill the 30-year fixed rate mortgage. But what happens is interest rates reprice, so the asset values also have to reprice. In England, Singapore, I forget some other places, but like basically where you have floating rate or 5 years, you'll see that repricing much more quickly than you see in the US.
Well, you'd hope
Um,
so, but Australia, we're all floating rate mortgages, and prices are at their peak right now on the national index and in most cities. Even though Canada, they're down, New Zealand, they've been falling for 4 years. We're the last ones, and we have the most floating rate mortgages. And I just, I'm not sure that it
so
really accelerates these adjustments if there's momentum in the market for other reasons, perhaps as well. What do you make
right,
of
so I
that?
don't know enough about Australia to know like again, the two big drivers are going to be demand and incomes, right? Like in other words, the more people you have with the higher incomes they have, home prices are going to go up, right? That's the fairly consistent finding. If you have lots of people who make less money, then you'll still have demand, but home values will probably not necessarily go up. If you have lots of people who make a lot of money, then home prices will go up. In Miami, you have actually fewer people, but the people who are there are even wealthier, so home prices still go up, even though there's fewer
Mm.
people. So I don't know what the story is in Australia, but I think part of it also could be, this goes back to the Glazer point and some of the things you're not really supposed to talk about, which is like there are housing is in some respects a status code, it's a positional, people will pay a premium to live in the best place.
Hmm.
Um, and that premium is fairly fixed, it could be 30 or 35% of income. So people, whatever the best place is, people will bid the marginal dollar to live there. So you either have to have a kind of great flattening where there are no great places. But if you have a relative scarcity of what places, nice places to live, or places where people perceive it, then those, then the clearing price is going to go up because the number of people globally who can afford it is fairly high. And if they're all going to
Yeah.
concentrate, at the tip of the iceberg, then you're going to see those localized price spikes.
Yeah, for sure.
Yeah,
So what I'm hearing from you is you've got a kind of pretty standard view. People spend out of income to buy nice houses, and as we get richer, we want bigger houses, and we compete for better locations. And to buy a house, we're sort of capitalizing the future income flow. That capitalizing process, depends heavily on prevailing interest rates in the economy and what we can borrow money for. That's a kind of my take as well. But I've also got this sort of overlay of there's a macro cycle involved here because the way we capitalize in housing and in other markets depends on our expectations as well. That can be wrong, and we can sort of rely on local feedback. Oh, everyone's buying houses. I bought it. The price went up. The rising prices justify me spending now more on housing, and this little like local feedback gets us this cycle. Do you take a view on the cycle? Have you heard about the sort of 18-year cycle and the Georgist sort of take? Or do you think it's more of there are shocks and there are adjustment processes? Look at COVID, look at the financial crisis. How do you resolve that
yeah.
in your mind?
So it's actually funny. The house that I grew up in had a Georgist stained glass the stained glass window with the Georgist emblem in it. Is built about in the turn of the 20th century in
Uh,
New Haven.
Sorry, can I
Just
just
a
explain
Yeah,
for a moment? Georgist is like the followers of Henry George, who wrote Progress in Poverty in the 1870s, and he started the single tax movement, just tax land and don't tax income. And his followers are very keen on the fact that the property market goes in 18-year cycles. So that's what we mean, just
right.
to clarify for the
So,
listener.
right. So even breaking those into two parts, like you could, I think there's some decent arguments for taxing property value and some making, so there's no vacant property, where the holding costs are fairly minimal. But yeah, on the 18, I don't buy the cycle. That's not persuasive to me. I guess I really do see it in terms of supply and demand. Um, and I guess part of my argument with certainly with the U.S. housing markets, but probably true globally, is actually the supply is fairly responsive to demand. Obviously, it's not immediate. These are capital goods that
Mm.
take time to build, but like for the most part, supply is pretty responsive. Like if you come, they will build it. Um, and that's borne out. And builders are obviously very motivated financial actors, so they are always looking to make money, and they will happily build as many units as they can, um, provided there's people with the right incomes to fill them. Um, so I'm not persuaded by some kind of 18 year anything that
Like
just that's
some
sort of recurring,
regularity to this pattern, that
you
based
know.
on generations, we need enough time to forget the last cycle. Because it's
No, because I think
funny.
the binding constraints are income, right? I mean, there's only so much you
Yeah,
can pay. And then, insofar as how that it flows through the asset prices, then becomes interest rates, right? Because
yeah,
the monthly payment is some combination of, principal, interest, and then your other carrying costs, insurance, which has gone way up,
yeah,
things like that. So, if interest rates go down, then the share that's allocated to interest is lower. So the amount that goes to principal is higher and asset values go up.
yeah.
But that doesn't mean people are spending more necessarily. That just means the asset values went up. But to me, yeah, the binding constraints are the number of people you have and the amount of money they make. And that's not cyclical. I mean, it's somewhat cyclical, but right now, what we
But
see is, but yeah, go ahead.
yeah, sorry, you would say that the cycle that we see in retrospect is just these adjustment processes to income changes and interest rate changes, and the economy is always adjusting. And when we look back on it, we're like, oh wow, it's going up and down. There must be some independent thing doing the cycle rather than there's just lots of adjustment always happening. And if you averaged all the peaks, you're going to get an average number, but they could just be, randomly. How the market adjusts to different factors at different times, whether it's lower interest rates, higher incomes, and migration shocks, and all sorts of things. Would you say that's closer to your view?
Yeah, I think if you were to look back, you would find that I think the data bears this out, that housing starts, per capita, track pretty cleanly and have actually, are actually relatively higher over the last 30 years. And, when certainly, again, I know the United States better than I know everywhere else, but like the United States was growing its population historically quickly, from the 40s onwards to the 80s or so. And so lots of new inventory gets built. And then as population growth begins to taper, but also the existing stock of homes, right? You don't always need to build new homes, right? Because once you have existing homes, then new buyers can move into existing homes. But the actual units per capita is stays pretty consistent.
Yeah,
And I think the big cyclical shocks, if you were to look back, it's not zoning rules at all. It's interest rates, right? Is it, interest rates getting relatively tight or loose, which is obviously cheaper capital for a capital intensive good is will
yeah,
facilitate, um, will facilitate supply and demand on both sides of it. And then when you have big reversals like savings and loans crisis in the 80s, or certainly the GFC, then you're going to get a big downward trends. And,
mm,
and and some of that is, I think, a function of, yeah, overbuilding. Like certainly in the lead up to 2006, 2007, like we did supply did run ahead of demand, probably driven, by rates and speculation. And, maybe in that sense, there was some, certainly on the investment side, like where some people were, buying second homes or investing in second homes. They weren't calling them second homes, but,
yeah,
um, on the sort of theory that home prices only go up and it's an easy investment. There was probably some of that, but I don't think that was sort of defined the excess of the cycle, not the cycle itself.
yeah.
And yeah, you have the big
Fair.
correction, then building, yeah.
So, you don't buy there's some regularity to the housing or the property cycle. What do you think about macroeconomic cycles in general? Are they trend driven? And if so, or are they driven by new technology and waves of innovation? I mean, that's a sort of Schumpeterian way of thinking of it. What's the next sort of big macro trend that we might see? I want to sort of move on from housing. You write a lot about the services economy, the generational flippening, all these new trends. What's the one that's sort of top of your mind that you think the consensus view is incomplete or wrong? or new
I mean, I think
macro
the one
trend?
that I've sort of alluded to it a few times, but I do think that by far the biggest macro story is demographics, and and I
Right.
think it applies to housing, but also elsewhere, which is we've had this almost century-long tailwind of a growing working age population, and it's rolling over, and it's going to go negative, and I don't think we don't know what that's like, right? I mean, it's one of the most consistent. Um, Growing working age population is the easiest, most surefire way to grow GDP that we have, right? It's not perfect,
Hmm.
but like certainly in the developed world, and it makes sense, right? A GDP is fundamentally the number of productive people you have times their productivity.
Yeah.
So you can add a lot of people who are not that productive, or you can add fewer people who are much more productive. But certainly, the demands on the productivity end of the spectrum go way up if you're just not adding people and if you're actually beginning to contract them. And that is that I think that's it's a huge driver. People kind of know it, but I don't think they fully internalized it, partly because again, the tailwind's been operating in the background for so long that we've just taken it for granted. But if you look at Japan, you look at China, you look at
Yeah.
Europe, who are a little bit further along in the age curve, and you can see the evidence of it everywhere. And I think we're hitting it. And a lot of the politics around immigration, and I think it all come back to that basic issue, which is, it's just like we stop making babies for whatever reason. Lots of people have lots of theories.
Yeah.
Um, and and
So, do you
now,
think
yeah.
people will adjust to the aging by simply working at different ages? So, I have a different sort of take. I mean, the aging of the pyramid, yes, we have fewer working age if we fix working age by this demographic number. But what's actually happened as we've lived longer and society's aged is we've started working later, we've studied longer, and we've finished working later. So if I look at the Australian data, for example, on when current retirees retired, so if you survey all the people who are currently retired and say at what age did you retire, it's something like 55 years old. Like people's bodies were broken in the 90s, right? And they're still alive when they were 55 in the 90s and they retired. And they're still alive. And that age has risen to something like 64. So
Yep.
in people who've retired in the last decade. And so we've seen this push of the working age population forward or upwards in our lifetime. And at the starting age, if you look at people 15 to 19 years old, half of them were working full time in 1980, and about 10% are working full time now. So we're sort of subtracting like 7 years of youth of and putting study and not work, and we're adding it at the back before we retire. So why doesn't that adjustment sort of resolve itself or resolve any of the economic headwinds that you might be worried about?
Right. So you're surely right. Like people are working longer. They're working longer in the US. They're working longer in Europe. I'm sure they're working longer other places. That's definitely part of it. But even if you extend the so-called working age population from instead of from 20 whatever 15 to 65 or 24 or however you want to define it, and you extended it
Mm,
out to 75 or something like that, you'd still begin to see decline. Um,
hmm.
the other issues I think are, there's there are other structural incentives in play, right? There's the so-called dependency ratio. We have, federal policy doesn't, entitlement policy doesn't necessarily kick in or change in response to that also. So you have,
Yeah.
you know, there were we had a massive pull forward of retirement, particularly amongst blue collar workers, which is, part of what created that real premium for, for blue collar service work. That was really the inflation story from 2022 onwards or so. Um, and it gradually as I say, like the open border was pro growth. Great replacement is real. It's pro growth, and it was deflationary. Again, to piss everybody off, but I think it's really kind of true. Is like, by the massive influx of fresh recruits, it really did help bring in, service inflation to heel for the most part.
Yeah.
Um, so I mean, so there are other so first of all, you're still going to have a tapering. Second of all, you have the dependency ratio with pension benefits and especially healthcare beginning to kick in, at the ages
Yeah.
that they kick in. And even if you extend them a little bit, it's not necessarily going to solve the issue. And the other thing, that people will say is like, well, what really matters is, per capita growth. and not necessarily, total growth. And like that's, at least from a quality of life standpoint, that's somewhat true. But again, the dependency ratio matters. So you're not going to necessarily have per capita growth if a larger share of the economy isn't working and, is basically, in elder
Mm.
care, which again is maybe, a socially important thing to do, but it doesn't make it economically any more pleasing. But also, of course, is the debt burden, right? Is this like debt doesn't care about GDP per capita, it cares about, your total tax base
Yeah.
and the share of those
Do you
revenues
mean
that could be,
public? Do you mean public debt? You mean bonds, public
yeah,
bonds?
yeah. I mean, national debt, yeah.
So do you don't buy the MMT or the view that, well, treasury bonds are internal to the economy. We owe them to each other, and the debt is just, the interest payment is just someone else's income in, who owns the treasury bond, and the macroeconomy circulates, and there's no constraint to how much we circulate money via treasury bonds or any other method. You don't buy that story.
I don't
Um,
buy in the infinite money glitch story, no. I mean, I think
Well,
there's parts of
it's
what
more infinite transfers, right? It's like, well, we're just cycling money around via treasury bonds. The interest payments go to someone else. That's their income. We tax that. We recycle it around. We're just kind of mixing up the blender, and there's no sort of limit to how mixed we can mix. It's all still in the blender. You don't buy that at all.
well, I mean, but where does the net dues, materials in the blender come from? I mean,
Well,
is
it
this
gets
just more money
inflated, right?
printing?
And then the debt. If there's not new stuff, we get inflation, and then the real balance goes down of the debt. And if there isn't, then that's good too.
I
Like,
get, I suppose, but creditors will care about that, right? I mean, if you perceive possibly seeing that now with the blowout of long-term rates, is why would anybody continue to lend at,
well, I guess
um,
this is again looking abroad as one of those methods. What do you make of Japan then? Like, can't the central bank, I think the central bank in Japan owns 50% of Japanese debt. And so essentially the
uh,
treasury is paying the central bank who's, paying, it's a closed system there.
well,
Um,
but the yen is for the first time, right? The yen is selling off even as interest rates go up. So like they're in a bit of a pickle.
well, okay,
There may
so
be a,
here's
a delayed lag. Yeah.
I'm interested in your take on that. So my sort of take on that is the Japan resurgence. This is look, I predict, despite the demographic headwinds in Japan being ahead, they're going to have another huge economic resurgence, and the rising interest rates are a symptom of this growth pattern that they've re-entered after decades of stagnation. What do you make of that story?
I mean, the truth, I don't know enough about the particulars of
Okay.
Japan to have a strong view. I mean, I think it's certainly possible. I don't, it may be that Japan, the worst of Japan's aging could be behind them also. But I mean, again, you look at their real estate crash. I mean, it's definitely a partly demographic story. It's, funny enough, they're actually Japanese pension funds are plowing lots of money now into the U.S. home builder ecosystem in M&A,
Yeah, they are.
which could be, it could be ultimate egg on their face. Um, I mean, look, at some level, right, what we know about debt and Minsky cycle, there is certainly a perception component to it, and you can kind of keep things as long as you think everybody else is going to keep kicking the can down the road, you can keep kicking the can down the road. Who knows how long that can go on for, and it can go on for an awfully long time, and it's not in anybody's real interest to have a run on the U.S. Treasury, right? I mean, that would bring everything. I don't know, maybe in the IRGC's interest, but like for the most part, right?
Yeah,
That's a doomsday scenario for everybody. So nobody's really rooting for the apocalypse. Um, but the nature of these things is that they can unwind very quickly too, right? I
yeah,
mean, that's the downside of them. I think for now, everybody is very motivated to keep on keeping on, and Wile E. Coyote ought not to look down. Um, but I don't know. Yeah, yeah, you could
look,
start to inflate away the debt. Yeah.
I guess when I zoom out, I guess my views changed on this too. Because when I zoom out, go and look at like the archives of newspaper headlines and the national debt. It's been a 70-year panic. And so I'm like, oh, probably I'm not going to get too worried about it now if that's been the case. So that's how I sort of softened my take a lot on that.
And my rejoinder is to say, well, first of all, 70 years is a blink of an eye in the big scheme of things, but also, right, well, the thing that's been true for the last longer than 70 years is that the population's been growing. And
Right.
you can continue to grow and you can grow your way out of debt with that tailwind at your back. But now that it's rolling over, the pressure to create real GDP growth is just as high as it was before, and it's just going to get harder. So that's where
Yeah. S- s-
yeah.
So yeah, I definitely take what you're saying that that there is a I don't want to say the line, but this time is different.
I think
So
this
my
time is different, yeah.
right. So my I guess my last question, while we're on that, you've got this phrase generational flippening, and since we're on the demographic shifts and their effects, what do you mean by that phrase and how it might play out in the economy in the next decade or so?
Well, I mean, so the generational flipping is just that, the Gen Z is very soon going to be a majority of things in the US, majority of the voter base, majority of the working population, and Gen Z is partly due to these demographic changes that we're talking about, like, lower birth rates, lots of immigration is very different. Also, technology is very different than the boomers and older, or the greatest generation, even Gen X that came before them. And I think in a lot of ways, there's almost a step change, and it can be hard to perceive a step change, certainly like a cultural step change when most people tend to be fairly insular. They sort of there's a reason why everybody feels like, you know, there's multiple countries, going, the partisanship is so high and blah, 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 blah. Partly is at
Huh?
some fundamental level is like people actually are quite different. And those differences and I think the generational dividing lines are somewhat artificial, obviously, but like
Yeah.
the youngs are not this are different than the olds. They're different in the type of information that they consume and the medium through which they get it, right? They consume a lot more through social media and alternatives relative to the sort of legacy, printer or cable TV kind of thing. Um,
Hmm.
and I think those you're already beginning to see some of that where I try to, I don't like to get into direct politics too much, but like whether it's Mamdani's like things like that, there is this kind of big generational gap in terms of what the up and coming, with the next generation, what they care about and what they
Hmm.
value, and it's different in very substantial ways than what the consensus that's held for a long time.
And you think this will
Um,
play out through politics as much as economic change through, the Mamdani sort of effect
yeah, I think they're
of
pretty
young.
related.
Yeah. Okay.
Yeah.
Interesting. And is there any prediction you have based on that that you think is unappreciated right now, or that is uniquely yours? Or do you think it's just a general trend and we kind of have to wait and see how it evolves?
I mean, I guess I don't know, uniquely mine. The iron law of greenfields is there are no greenfields, right? There's no, any idea you think you have, somebody else already has, or some version of
Good
it. I
point.
mean, I think that I'm probably more attentive to this issue as a kind of, the grand theory to explain everything than most people. I think it's
Uh-huh.
manifested itself in a number of accurate predictions. Look, the other part of it too is like, if you're right, if you're early and right, you're not going to stay contrarian for long, just because the information cycles so quickly, and eventually consensus catches up to you. Even could be a matter of weeks.
Yeah.
I mean, I think the things that I've been right about is that healthcare continues to be a major driver of employment. That you have a premium on some of the services, especially where demand is inelastic, as in when Uncle Sam is paying the bills, right? So like healthcare and things like that, where that
Yeah.
comes back to the dependency ratio and the shortage of service workers, but also shows up in insurance prices because the cost of labor is higher, and even if construction demand is soft, because again, demand is soft, but you still have this big pull on the skilled trades. Again, that I've been writing about for years. Plumbers,
Yeah.
contractors, specialty contractors. At the same time, you talked about the kind of delayed onset of adulthood and people starting their working life later. Is the reason that happened is because people bought college degrees on credit, right?
Yeah.
To analogize to to the financial crisis, if those were toxic mortgages, sold by Wall Street, like now we have toxic degrees, sold by Uncle Sam kind of thing. And again, you have the huge explosion of student borrowing that now can't be repaid because the degrees are not as valuable as people had hoped for.
Yeah,
And
we have a lot of that in Australia as well. We have a national
Sure.
lending called HEX, or help debts, we call them, and the federal government pays for your degree and you pay it off through your taxes and extra
Right.
tax. And there's, I know
Right. And
plenty of
people,
plenty of people who haven't paid it off after 20 years. In fact, they just recently forgave last year 20,000 per person on their outstanding debts to the government for their university.
yeah.
Yeah,
And we have that too, right? And that's a big political push too, is debt forgiveness and things like that. And because it goes back to that core demographic of people, they borrowed a lot for these degrees. They're not
yeah.
generating incomes commensurate with their expectations. And some of these are status issues, the upwardly mobile. Um, it's these are relative, even if in real terms people's situations are getting better, the relative terms are not, at least not in line with their
Uh-huh.
expectations. And I think, yeah, social
Yeah.
media makes it worse. Yeah, but yeah.
Well, as I said at the beginning, when we were talking housing, I definitely see that manifested in housing and the frustrations as well. And I think maybe it's part of your bigger point of a generational change that we haven't quite appreciated that is coming down the pipeline. Moses, mate, I might leave it there. I know it's getting late for you with the time zone difference. Can I just suggest to everyone to go to Random Walk? I'm going to put a link in the show notes to get a very independent take on all the economic trends. Is there anywhere else people should follow you, Moses?
You can follow me on Twitter. I've been doing I'm working with Andreessen Horowitz, say 16Zs. We're doing a lot of work over there too. So follow that newsletter.
Oh, terrific.
Yeah, I mean it's great. Yeah, it's been great. So a lot of talent density there and really interesting stuff. And so that's been a fun recent development. No,
Brilliant.
I don't know. I guess like even before, I'm just sort of curious. Like, how about sort of flip it to you? Do
Oh, yeah.
you the same question? Like, do you have a is there some forecast that you have that you think is X consensus,
Uh,
that relative to the main?
well, I guess my forecast at the beginning of this year was that Australian property is going to come down and rents will come down because of cyclical factors. Despite immigration being relatively high still, and people thinking that means prices can never fall. So that's been one. I guess my longer term take is, I don't know how contrarian it is, but the public debt is not going to turn into a crisis in the US, Australia, major economies in my lifetime. That's my sort of zoomed out long term one. Uh,
And the
and
reason is just because it hasn't up until this point, so it won't going forward, kind of thing.
No, my reason's more macro that, if central banks can defend the interest rate of their local currency, they can defend the interest rate of their local currency. They can do it basically. Um, they can buy the bonds, or they can buy what we call exchange settlement balances, which is like M1, the central bank money in Australia. They can do whatever they want, um, and
Without
have done
inflation.
well. Not that we can definitely prevent inflation. I mean, the high interest rates are not because of the bond market not wanting to own US money. It's because we central bank wants the interest rate to be higher to prevent inflation, right? Like that's what's happening in Australia. We could have one
So I
percent
think it's
interest
probably a bit of
rates,
both.
but we'd have more inflation. So that's one of my sort of long term views. I think on the
I mean, the,
generational,
the, the marginal the marginal buyer of net new treasuries has been investors for the most part, right? The Fed has been, I mean, it switched, right? It
but
was it was
that's
gone back to quantitative
uh,
easing ish.
yeah.
Um,
I'll give you a different causal story then. The interest rate is high to make investors buy treasuries and stop them spending money building new factories to prevent inflation. Like that is the causal direction of things. It's not that, oh, the last buyer would only buy because the interest rate was 5 or 6%. Like we made the interest rate 5 or 6% to tempt that person to buy treasuries instead of giving money to their mates to build houses. Like that's because we don't want them to build too many houses right now because it's inflationary and the cost of contractors is high. I mean, that's the case in Australia for sure. That's what we're
Right.
trying to do.
But then you have the other issue, which is right. Then you get the the squeezing out, right? Is that, and we saw this in the U.S. too. It's just like non-government lending contracted enormously while government borrowing went up, right? So there was of the available, Uncle Sam hoovered up much more of the available capital flows than
Yeah, I
anywhere
mean,
else,
isn't
and
but that's what we want to stop inflation, right? Because private lending is going to build houses and factories and stuff and employ contractors. I mean, so my take is that this is the intended and predictable monetary policy effect, and if the economy did sort of contract substantially, we'd do the opposite, and you'd see all of a sudden there's all this extra private lending available, and people are still willing to buy treasuries at 2% or 1%, whatever it is, but it would reverse. So that's sort of how I see that holding together, and I guess why I don't um, have concerns. And I guess if I was to bet, if I could bet against the US having a treasury, a fiscal crisis, then I would bet against that for sure.
yeah, I guess the flip side. I mean, I always like, take issue a little bit with the we want high interest rates to lower inflation. Like to me, it depends on what's driving inflation, right? I mean, if you had a famine and food prices spiked, and then you raise interest rates, you'd be a monster. Like in that case, you don't want to add a capital shortage to a food shortage, and if part of the issue is people are not buying cars and houses because capital is artificially scarce, right? Like relative to what it ought to be because of the yields that Uncle Sam has to pay in order to generate enough demand for its borrowing. Like that doesn't seem to be a good out to pay
Well,
for eldercare, right? If yeah.
yeah, I mean, I think I'm with you on the point that if so, and I argued during COVID, we dropped interest rates to keep the economy going during a lockdown, and I'm like, is that really the right mechanism for that? Because it's a very blunt thing. It's going to make all this borrowing cheaper, and we're all going to buy houses and stuff, and all at the same time while we're locked down, and we did, of course, every country sort of did. So I thought that was true on the flip side as well when we
Yeah.
stimulated. And I think it's sort of partly true, but I don't know if I've got a better idea to sort of suppress the runaway sort of inflationary cycle that was triggered by that event, besides putting interest rates back up and making people borrow to buy a house at 6.5% instead of 2.5.
I
Um,
mean, part of the issue is, of course, they should have picked one of fiscal stimulus or monetary. They shouldn't have done
well,
both, right? Like, so,
yeah,
yeah.
that
But
yeah,
even just to
I'm
analogize,
with you
like
on
to
that.
come like
Yeah.
imagine, it wasn't the government, but say there was just a giant nursing home, and that giant nursing home, for reasons one couldn't fully explain, was able to pay, a higher yield on its debt than anybody else in the economy. And so you have
Yeah.
this massive nursing home, which is, hoovering up all the available capital. Like, does that sound like a good, uh, I don't know, effective, efficient allocation of capital to you?
Well, I mean, it sort of sounds like you're saying, well, for starters, if the nursing home had its own currency and was internally sort of operating and we had to exchange the external currency for that, then it can do whatever it wants. Um, but it sounds like you're saying that just monetary policy you don't think is a great way in general to manage the macroeconomy and manage inflation. Would you say that you've got some reservations in general about that approach?
Yeah, I think it depends what. I think if the problem is that, government yield, that monetary policy is too loose, then it's a good mechanism. But if the problem is something else, then it's not, right? I mean, if you're having a run up in
Yeah.
prices on memory because the
Oh,
the hyperscalers are buying every memory chip, then I think monetary policy is a terrible mechanism in that case. That would make things worse, right? But I think if it, as I like to say, like, if the old Volcker line is, oh, you need to raise rates to stop the overheating economies. Like, economies don't overheat. Like central planners might overheat.
yeah, right.
You might need to raise
I,
rate, yeah.
so you're basically saying there's a more active role to manage inflation from fiscal and public investment in the economy. to tackle the particular inflationary causes at a particular time. Like take a more commercial stance as a public sector and go, if there's inflation from this thing, maybe we can try and help you build more of that thing. Is that what you're sort of getting at?
Yeah.
Yeah,
Yes,
yeah.
I think if the Fed is, buying up, ABS, loading up its balance sheet and, artificially, buying up agency loans at, a 30-year interest rates at 2% or 1.5%, and that's causing home prices to go up in excess of,
Mm,
what real demand, which is incomes and people would support, that then higher interest rates is a good fix.
yeah.
But if it's not that, then I think it's a less of a, and I actually think that's not contrarian anymore. I think a lot of people are beginning to understand that, the fiscal train is in the driver's seat for the most part. And
Wow.
there's only so much that the Fed can do.
Do you follow the MMT guys at all, the monetary guys? Because that view on more active fiscal to manage inflation is literally what Stephanie Kelton writes in her book, which
I
was the
don't
sort
follow
of,
that. I used to read Scott Sumner.
oh yeah,
I
yeah,
don't as much anymore, but yeah,
yeah.
I don't, yeah,
But I think that's just a generally sort of true thing. We've been through a cycle of monetary policy supreme. This is the one and only lever. Anything that contributes to inflation will pull this lever. Whereas I think you're right that the recently the mindset has shifted to, yeah, you can pull that lever, but if there's inflation because of a war, because of this resource or this resource, maybe you can do something more targeted and active fiscally to support more production of that resource or a buffer stock of oil or whatever the case may be. You need to take a more sort of active and commercial approach rather than this. We have one big lever where, like the Wizard of Oz magician, pull lever,
yeah.
magic happens. You agree with that,
Prices
man?
go
Yeah,
up, interest
yeah,
rates ought to go up too. I think is not a very wise
yeah,
axiom.
fair
And
point.
also, like again, the cure to high prices is high prices, right? So in many cases, right, that's the sort of natural constraint on demand is just the prices go up, and that has its
Yeah,
own effect.
it's
But
funny
yeah,
because people tell me, what do I do with housing? And I'm like, well, you wait, because like the cure for high
yeah.
prices is high prices. I'm like, well, if you think it's too expensive, don't buy it, and if everyone else who thinks it's too expensive doesn't buy it, then the price will come down, and
I mean,
that's how the economy works.
when I've written, I said when it comes to housing, waiting is the hardest part. It's some of that's a feature of the 30-year fixed rate mortgage, which is just like you have this, the pass-through mechanism is on all of the markdowns in home prices sat on bank balance sheets is unrealized losses, right? All of
Uh-huh.
those now underwater low interest MBS, that SVB, recklessly and First Republic recklessly had because the Fed gave it to them, right? All of that depreciation could have sat with homeowners had they didn't have the sort of artificially, the 30-year mortgage, as it did in commercial real estate where asset values did reprice. But if you have a 30-year, basically the repricing sits on bank balance sheets until it slowly winds down. And yeah, and then
Mm.
eventually like the only clear is that eventually people will capitulate over time or incomes will rise to meet the bid. Right, but the bid
Yeah,
ask will stay too wide. Yeah.
that's right. I tell people either prices come down, interest rates come down, or incomes rise, or some combination of the three.
Yep.
Um, and you just wait
Yeah,
until
I
you
mean,
think it's a
Goldman
better.
Sachs has a great chart that they used to make. It's basically like what, of those three factors, right?
Yeah.
Either interest rates have to come down, 400 basis points, incomes have to rise 68%, or home values have to decline by 30% to achieve so-called affordability, which
Yeah.
is to say to close the bid-ask spread. And what of those
Or
things
some
is most likely going to
combination,
happen?
right?
Yeah.
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 So part of half of
Um,
everything or a third of each. Yeah, yeah. Look, Moses, I appreciate you giving me your time today, and I appreciate your insights and independent take on
Thank you. Yeah,
things, which is, I think, um, it's not as common as you might think, but I think slightly more common with Substack and those type of outlets that allow people like you and me to have these conversations and really nut it out. So thanks very much
for
for coming.
sure. Thank you. Actually, now I do have to bounce, but yeah, this is great.
Yeah.
Appreciate it. Anytime.